Hello everyone, good morning, good afternoon, good evening, depending upon when you are watching this video lecture. In the earlier sessions, we discussed about the theory of demand and the elasticity of demand and how to compute the elasticity of demand, etc. So the various aspects related to the concept of demand have been discussed in Unit 1 of Chapter 2. And before going to the MCQs, let us quickly revise what was the essence of this unit named as demand. All of them have already been discussed, but just to recapitulate what has been discussed, let us quickly go through the summary of this topic. The first point says, definitely the buyers constitute the demand side of the market, and naturally the sellers will make the supply side of the market, which we will discuss later. But generally, the quantity of the commodities that consumers buy at a given price is what we call as size of the market. That can be called as market demand, which is nothing but the aggregate of all the individual demands. That is what we can call as size of the market. And as we know, market economy operates on the principles of demand and supply and the price mechanism related to that. So the demand side is also called as buy side, supply side is also called as sell side. For a market to exist, both will be there simultaneously, then only there is a possibility of a transaction, and naturally then only there is a sale that happens and a purchase that happens, and then only we can talk about the demand and supply of goods and services. That is the general understanding of how the market works. Then the second point says, what is demand? Demand is nothing but the desire or wish to buy and consume a commodity or service. Of course, just a desire does not constitute demand. That should be backed by adequate ability to pay. There should be purchasing power for the people to buy the commodities what they want to buy. So there should be desire also, there should be ability also, and even if both are there also, it is not enough, there should be willingness to pay. So the desire coupled with the ability and willingness to pay constitutes demand. Next, what are the factors that generally will have an impact on the demand, or what factors will have influence on the demand? All of them we already discussed. One most important factor is price of the commodity, and then the prices of related commodities, incomes of the consumers, tastes and preferences of the consumers, also the consumers' expectations related to the future prices, and other factors like demographic things, size of population, composition of the population, the level of national income, like macroeconomic factors, how the distribution of national income is happening in a country, consumer credit facilities, how they are available, interest rates. Like this, numerous factors will have an impact on the demand. We can call all of them as the determinants of demand. And this list is not some exhaustive list. This list is indicative list. In general, these are the major influencing factors on the demand. In addition to that, there can be any other factor also. For example, something like advertisement expenditure also will have an impact on demand. Like that, many other factors will also have an impact on demand. But this is only just an indicative list of some of the key factors that will be influencing demand for a particular product or service. That is the list of the determinants of demand, we can say. But of course, as we have already observed, all these determinants definitely have an influence on demand, that does not mean we will be able to quantify the magnitude of that impact which they can create on the demand. Some of them we quantify, and when we quantify, that's what we call as elasticity of demand. So whether we can measure it or not, whether we can quantify it or not, these factors will definitely influence demand. The question of how strongly they will be influencing the demand or how weakly they will be influencing the demand can only be measured by using the concept of elasticity of demand, which has also been discussed earlier. And what is law of demand? The law of demand is very simple. What it says is, the people will generally buy more at lower prices. That's what generally what people do. And they will buy less at higher prices. Of course, other things being equal. This has to be also always kept in mind. When we are testing the influence of any factor on the demand, we have to keep in mind we are testing only one factor at a time. We are not using any high level 3-dimensional, 4-dimensional analysis at the same time. No. Ultimately, our restriction is only towards 2-dimensional analysis. 2 dimensions means a normal graph that we see, x-axis, y-axis, that's all. That means there are only 2 factors, the relationship between which we are testing on a normal basis. In this case, the law of demand tests the relationship between the price of a product and the quantity demanded of that product. 2 factors only, the relationship is being tested. Of course, since we are talking about demand, one factor always is going to be demand. Other factor will change. If we are testing the relationship of quantity demanded with the price, that is one separate analysis. Or if we are testing the influence of prices of related commodities on the demand, that is another one. But all of them we are not going to test at the same time. That is not possible with 2-dimensional approach. And our restriction is definitely only restricted to 2-dimensional approach. So that limitation we have to always keep in mind. Of course, in reality, will the world work with 2-dimensional approach? Definitely not. The world works multidimensionally. There are seamless possibilities that can happen in the real world. But the problem is, all those possibilities we cannot bring into the theories that we are learning here. So that is why always we have to keep in mind the limitation of these models is about testing the influence of one factor at a time only, not multiple factors at the same time. If we say, is it not possible? Then the answer will be always anything is possible. Nobody can say it is not possible. So the technology is there, mathematical models are there, high level intellectuals working on that, the economists will definitely do those things, multidimensional analysis. But that is not our scope. So we have to restrict our analysis only to 2-dimensional analysis, which means there is one factor and there is another factor, and we are testing the relationship between these 2 factors. Or for simplicity purposes, we can say there are 2 variables. One is a dependent variable, other one is an independent variable. For example, in all these cases, what we are talking about is the impact on demand. So the dependent variable in all these analysis is always demand. That is a dependent variable. But the demand is dependent on what? Dependent on many factors. So how demand is dependent on price? Separate topic. How demand is dependent on prices of related commodities? Separate topic. Even within that, how the demand is dependent on the substitutes prices or complementary commodities prices. Each of them is a separate analysis, a separate discussion. So once again to note, other things being equal is an important point always to keep in mind. within the limitation of our two-dimensional analysis. And also we discussed about what is a demand schedule, which is nothing but a table. You use the word table or you call it a schedule, it doesn't matter, both are same, but schedule is a little sophisticated word that we use. That's why we call it as a demand schedule. What is that? Basically, it is a table showing the various prices and the corresponding quantities demanded. That's it. And in general, the demand schedules can be of two types, which we also discussed. One of them could be individual's demand schedule. The other one is market demand schedule. Market demand schedule is nothing but the aggregate of all the individual demand schedules. So individually, if we take one customer or one product, that becomes an individual demand schedule. If you sum it all of them together, then the resultant is called as market demand schedule. So that is nothing but a table showing various prices, and at that price, how much would be the quantities demanded in relation to that product or service. That's what is a demand schedule. And according to Marshall, the demand curve slopes downwards. Why does it happen? Simply speaking, because of the operation of law of diminishing marginal utility, which we are going to discuss in the second unit as part of consumer behavior. But at least what we know now is the theory of demand as well as the demand curve having a downward slope, sloping downwards from left to right, is indicative of what? It is indicating the prices of commodities and the quantity demanded are inversely related to each other. In other words, when the prices increase, the quantity demanded will decrease. When there is an inverse relationship between the two variables we are talking about, then naturally the demand curve slopes downwards. That's what is law of demand actually. But why the law of demand occurs? Why the law of demand is actually fulfilled? According to Marshall, it happens because of the law of diminishing marginal utility. It is not because of other factors, it is because of the law of diminishing marginal utility. The demand curve slopes downwards according to Marshall. That is his contention, which is right. We cannot say he is wrong. But he may not be telling the entire story. Then what happened? Two other people, Hicks and Allen, argued that this demand curve sloping downwards is because of two possibilities. One is income effect, the other one is substitution effect. Both of them we discussed already. But the point of income effect or substitution effect, or sometimes both happening at the same time, will have an impact on the demand. Wherever the prices are increasing, the quantity demanded will decrease because of either of these two effects, or sometimes both of them working simultaneously according to Hicks and Allen. So definitely Marshall also, Hicks and Allen also are agreeing to the result that demand curve slopes downwards. The price of the commodity and quantity demanded are inversely related. There is no opposite views. But when it comes to the reasons why that happens, there are different views. We cannot even call them opposite views. There are different views on that. Marshall says this happens because of the theory of diminishing marginal utility. Hicks and Allen say it is because of income effect and substitution effect. That is about why the demand curve slopes downwards according to different economists. Of course, will the demand curve always slopes downward? Generally, no. Not always. Usually, yes. Usually, it slopes downwards. But exceptionally, it slopes upwards also. Means what? We can say these are exceptions to the law of demand. Normally, according to the law of demand, the demand curve must slope downwards. Because these are exceptions, it not necessarily be sloping downwards. It may slope upwards, it may be not changing also. It might happen in any way. Don't directly take this sloping upwards in literal sense. But one thing for sure, it may not slope downwards in the exceptional cases. In the exceptional cases, always will it slope upwards? Doesn't matter. That is not what we are talking about here. Exceptionally, it will not follow the law of demand. Certain types of commodities and certain circumstances will not follow the law of demand, which means the demand curve does not slope downwards. How will it behave? That is a different story. It will behave according to the nature of them. It can slope upward also. It may not change also. A lot of things can happen. Like what? For example, in case of conspicuous goods, even though the price increases, the quantity demanded may not decrease. So the demand curve for conspicuous goods may not slope downwards. For given goods, once again, the inferior goods we can call them. Conspicuous goods are also called as the Veblen goods. Inferior goods are called as given goods. There also the law of demand may not apply. Conspicuous necessities also the law of demand may not apply. These are all the exceptions which we discussed in the earlier classes. We can call them as all exceptions to the law of demand. And when there are expectations about the future prices, then also the law of demand may not apply. In general, it applies. In general, it is applicable under normal circumstances, but under certain cases, under certain circumstances, it may not be applicable also. That is also a point to be noted. Then another thing, of course, always keeping the other things equal. This is always the common point. When price rises, as a response to that, quantity demanded decreases. Same thing, what we are talking about as law of demand is that only. When the price increases, the quantity demanded decreases. What we can call that? Can we call it a decrease in demand? No, we cannot call it a decrease in demand. And once again, I am repeating the quantity demanded. This is not demand what we are calling. We are calling it as quantity demanded because we are testing the relationship of the demand with price. In that context, we use the word quantity demanded. So whenever the word quantity demanded is used, in general, it means we are talking about a change in some price of that commodity. So price changes, quantity demanded also changes. If the price increases, quantity demanded decreases, and we call that contraction of demand rather than decrease in demand. This is where we have to be little pragmatic about understanding these words. These are just words. What happens if we call it decrease in demand? Nothing happens. What happens? But that would not be technically correct. So just to distinguish one category of analysis where we are testing the impact of price of a commodity on the quantity demanded, in that context we use the word contraction of demand rather than using the word decrease in demand. But what actually is happening? Decrease only. That is decrease only. But instead of calling it as decrease in demand, we call it decrease in quantity demanded. That is okay. Or on the other side, we can call it as contraction of demand. That is okay. We cannot call it decrease in demand because that is used in a different context. Not that just these names are giving completely different meaning. No. The place at which these names are used is only just different. So the point is, when we are testing the price change and its impact on the quantity demanded, it is always better to use the word quantity demanded rather than using the word demand. Same way, rather than using the word decrease of demand, it is better to use the word contraction of demand. This is what is norm. This is not law. This is not rule. There is no thumb rule like that in the world. If we don't use this word, if we use something else, in reality, nothing is going to happen. Nobody is going to ask us. But in the exam, definitely it is going to lose us marks. If we don't use these exact technical words and we try to create some new words or we try to implement something else here. So please don't be creative in certain areas. particularly where there is no valid reason for such distinction. All that we need to do is understand, okay, this is what it is called, so be it. So be it. That's all. And we have to move on. We cannot stay here with the demand, quantity demanded, increase, decrease, contraction, expansion. These things are not, the names are not what have to be focused on. What is the essence of that has to be focused on. But having said that, can we ignore the names? No. Can we just use these names interchangeably? No. That is a simple, I would say, technique or knack, or rather I would call it little bit of smartness in understanding what is required for the examination. We need to focus on that rather than thinking about what if in a different situation the same name is used. Let it be used. Nothing happens. Actually, nothing happens. You call it demand, you call it quantity demanded, you call it expansion, you call it contraction, or decrease, expansion, increase. You calling it in a different way practically has no impact on them. It is only a practice that we use these words. So let us unnecessarily not waste time on these things. This is simply names of what we are indicating something. So when we are indicating when there is a change in the price, what is the impact on the demand? We don't call it demand, we call it quantity demanded. And when the price is increasing, quantity demanded is decreasing, we call it contraction of demand. On the other side, opposite happens. When the price falls and the quantity demanded naturally increases. When the price is decreasing, quantity demanded is increasing. Once again, we are using the word quantity demanded here, not demand. And when it is increasing, you can call it as expansion, extension. Extension is not a good word. Better to call it expansion of demand and contraction of demand, opposite sides. So when the quantity demanded decreases, it is called contraction of demand. When the quantity demanded increases, it is called expansion of demand. So better to use that word here rather than this. So in the place of extension, you use the word expansion of demand. So that is about wordings, what we have to use. But essence is same. Essence is always the same. Essence is what? Price increases, quantity demanded decreases. Price decreases, quantity demanded increases. That's all. That is essence. What we call it? Yes, we use different names. When the quantity demanded decreases, we call it contraction. When the quantity demanded increases, we call it expansion of demand. That is about expansion and contraction of demand. What about increase or decrease in demand? This will happen not because of the changes in price, because of the change in any other factor other than price. Again, which factor? Infinite factors. Price is only one, where we use these words quantity demanded, expansion, contraction. In all cases other than price, we use the normal words. We use demand, increase in demand, decrease in demand, like that. And what are all those factors? We know them already. At least a indicative list of them is already known. So if there is a change in the other factors, what happens to the demand curve? Demand curve definitely shifts rightwards or leftwards. But when the demand curve will shift rightwards, when it will shift rightwards, rightwards means what? First of all, it is indicating a increase in demand, not expansion. We are talking about increase in demand. When that happens, when any change in the other factors happens other than price. And what are those factors? What factors might have an influence on the demand and they might increase the demand? When there is a rise in the income. Yes, of course, exceptions are always there, like inferior goods. Keeping them apart, normally when the income rises, demand also increases. That means the demand curve will shift rightwards. Same way, if there is a rise in the price of a substitute, then also the demand curve of the original commodity will move rightwards. When there is a fall in the price of the complementary commodity, then also the demand curve shifts rightwards. Other factors like rise in population, possible. Change in the tastes in favor of the commodity, possible. Like this, the demand curve will be shifting rightwards because of change in any other factors other than price. Same way, the demand curve will shift leftwards if the opposite happen. What are the opposites? For example, fall in the income, demand curve moves leftwards. Fall in the price of the substitute, demand curve moves leftwards. Rise in the price of the complement, then also the demand curve shifts leftwards, like that. Population decreases, the changes in the tastes are not in favor of the commodity, they are against the commodity. All these things will happen. The opposite things will happen when the demand curve is moving leftwards. That is called shift in the demand curve. So the movements are going to be on the demand curve when we are testing the impact of price on the quantity demanded. The movement is going to be along the curve. Whereas when there is a change in any factors, any other factor other than price, then the movement is not going to be along the curve. The movement is going to be either rightwards or leftwards. So if already this is the demand curve, if the movement is rightwards, that means there is an increase in demand. If the movement is leftwards, that means there is a decrease in demand. And when will that happen? When any change is going to have an impact on the demand, either in the form of increasing it or decreasing it. That is a possibility. Any of them are possible. We have to just understand that particular case which we encounter in the question that is given to us. That should be our focus point. Our focus has to be on the concepts and application of them to the extent of the questions that are asked. That should be enough. Beyond that, the scope is infinite, and that will be not possible also to really look at all the thousands of permutations and combinations that might happen in the real world. That is beyond our level of understanding and requirement also. So keep that in mind always while learning these topics. Yes, we do use lifetime examples, we do use real life examples, but they are examples. Only for understanding the concept, those examples have to be taken. Examples should not be taken seriously. We cannot take examples as concepts. No. Concept is a concept. To explain that, to understand that in a better way, examples will help us. That's all. So understanding the limitation of examples also is a crucial part. Otherwise, we tend to develop our own theories according to our own examples. That will lead to wrong answers, nothing else. When wrong answers are there, definitely the marks will be lost. So, for obtaining good marks, we need to be thorough with the concepts and definitely well versed with the application of those concepts in the context that is given to us as question. There ends the matter. And there is another issue also here, because this paper is an MCQ paper, objective type paper. In the question, some details will be given and the answers are possibly only 4, not beyond that. If a question is asked, the answer has to be one of the 4 options only, A, B, C, D, one of them only, not one more than one, which means we have to be precise on selecting the correct option, at the same time ignoring the wrong options. So we should know why are we selecting the correct option also. Preferably for most of the questions, we should also know why are we not selecting the remaining 3 wrong options, why they are wrong. That we should be clear about. That is enough. That's what is required from us. But once again, if we extend our thought process, in the real world, will the 4 options only be there? There will be millions of options. We cannot help them. We cannot bring all of them here. We are not writing a descriptive examination. If it is a descriptive examination, we can have a lot of points which can be made from different sides. Here that is not possible. We have a question, we have 4 options, we need to identify one of the options only. Though we know There may be multiple other options also in reality. Those are all to be excluded from our purview. So this smartness in learning process is also part of it, part of this approach towards chartered accountancy course. It is not just about subject. Subject is definitely important. It has to be coupled with some other qualities like this, where our focus has to be very pinpointed. So that is a point to be always kept in mind by every student. Anyway, coming to what is elasticity of demand, it is nothing but the degree of responsiveness or just responsiveness of the demand to a change in any one of its determinants. We know already there are so many determinants. If any one of those determinants changes, how it will have an impact on the demand, how the demand is responding to the change in any of the determinants is measured by elasticity of demand. That is why we are calling it as a degree of sensitiveness or responsiveness. That is elasticity of demand. In general, once again, are these only elasticities of demand in the world? No, sir. There might be many others also. We are focusing only on them. That is our restriction. In general, we can classify the elasticity of demand into 4 categories. One is price elasticity of demand. Second one is income elasticity of demand, or advertisement elasticity of demand, or cross elasticity of demand. As far as our syllabus is concerned, these 4 are enough. Once again, a doubt might come. So that's all, only 4. There are no more. No, there might be hundreds of them. We are not the ones to check all those options. Our restriction is only on these 4. That is enough for us. So price elasticity tests the strength of the relationship between price of a commodity and the quantity demanded of that commodity. Same way, income elasticity tests the relationship, the strength of the relationship between the income of the consumers and the demand of that commodity. Same with advertisement elasticity, which tests, once again, the strength of the relationship between advertisement expenditure incurred by the organization and the demand of the commodities which are sold by an organization. Cross elasticity refers to the strength of the relationship between the prices of the related commodities with that of the original commodity. In other words, how the price of substitute will have an impact on the demand of original commodity is measured by cross elasticity, and same thing can be applied to complementary commodities also. That is the basic concept of elasticity of demand, in which majorly we focus on price elasticity of demand. And what is that price elasticity of demand? We have discussed extensively. That is nothing but the percentage change in the quantity demanded of a commodity as a result of percentage change in the price of that commodity. That's what is price elasticity of demand. But in general, because the demand curve slopes downwards, the sign of the price elasticity is negative. Naturally, it is supposed to be negative. But because we know it is going to be anyway negative, we ignore this sign of the price elasticity and we concentrate on the coefficient, that is the actual number, absolute number. So once again, here also care has to be taken. Are we going to ignore the sign plus or minus in all types of elasticities? No, sir. No, nothing like that. It is going to be only for price elasticity. Once again, sir, how can we ignore? We don't have to ignore also actually. We don't have to ignore also. But if it is almost guaranteed that always the price elasticity is going to be negative anyway, we can take that sign as granted. When we are ignoring does not mean we are not considering it. It only means that it is taken as granted. We don't have to every time tell that price elasticity is minus 2.5, minus 1.8, minus. We don't have to tell that. We don't have to express that. It is inherent. It is already inherent on the part of the nature of the price elasticity, which is bound to be negative. So we are trying to just ignore that sign. Again, that does not mean we are doing some crime by ignoring that. It is a practice. I would not ignore. No problem. Let us not ignore also. It's okay. But what if in the 4 options there is no negative sign? Then where will go? Because you don't have a 5th option, right? That is where we have to be careful. That is where we cannot create our own arena. We have to be focusing on the essence of it. Essence of it is what? Definitely price elasticity going to be negative. If it is given as negative in the options, well and good. If it is not given, then we have to understand that, okay, probably in the answers, the sign has been ignored. That all has to be interpreted by us. We cannot draw hard and fast rules here. There is no hard lines and hard rules. According to those rules, according to my rules, the questions will be not possible. According to our rules, the questions will not be asked. According to our convenience, the questions will not be asked. They will be asked in different basis. Some questions they may not ignore the sign also. For example, in some questions they will not ignore the sign, they will put it minus only. Then we cannot say, sir, in this point we said we will ignore it, but they have not ignored it. What we can do if they have not ignored it? We cannot do anything. So there is no rule like that we have to ignore it. We normally ignore it. So this word normally, generally, these are the things to be understood, and we need to have that cushion. If we are not having the cushion, definitely that is going to create friction, and that friction will not let the subject go inside our brain. So rather than creating such obstacles, we should make it smooth flow. That is important. So that much of shock absorption we should have. Otherwise, definitely it is going to be painful in understanding different situations. Because this is just the beginning. In this chartered accountancy course, there will be many situations where the treatment is in one way at a particular instance, and more or less a similar situation, but the treatment is completely different in another instance. We cannot say I am getting confused because of that. No. We cannot be confused because of that. We have to understand that this situation warranted this treatment, another situation will warrant another treatment. That's all. We should have that flexibility. That is very important. But flexibility does not mean we are defying the basic rules. No. Basic rules are not defied. Basic rules are always there. That is the theory. That is the core concept of demand, core concept of anything. That will not change. These are all peripheral things, the names of them, the sign of them. These are all the things which are just peripheral. So those things, little bit of cushion should be there, little bit of relaxation should be there. According to whatever the question asks, we need to answer the question. Again, the point is, ICI is testing us. We are not testing ICI, whether this is a correct treatment or not. It is not actually. But if we say it has to be ignored, let it be ignored. If the sign of the price elasticity has to be ignored, let it be ignored. It is not going to have a huge impact on our understanding. It should not have. So once again, what matters in the case of price elasticity is the absolute coefficient, the number. What that number indicates is the responsiveness of that product's quantity demanded due to a change in price. If that absolute number related to the price elasticity is more, that means that that particular product is more price elastic, which means the responsiveness of that product to the changes in its price is very high. So even for a small change in the price, the quantity demanded of that product changes drastically. That's what the higher coefficient or higher price elasticity indicates us. Negative sign indicates what? Negative sign indicates the opposite direction, the relationship, the inverse relationship between the price of a commodity and the quantity demanded, which is taken as granted because law of demand anyway tells that there is a relationship which is inverse. So if we consider that as granted, we can ignore that sign also, is what is the point made here. Once again, take them what they are just telling, that's it. Not to really take it. We don't have to ignore compulsorily. If it is ignored, let it be. If it is not ignored also, let it be. No problem. Let it be like that. So that is how price elasticity has to be calculated. The percentage change in quantity demanded divided by percentage change in price. That's what gives us price elasticity of demand. And the elasticity of demand can be also calculated by using some of the other techniques like point elasticity, which generally is done while taking a given point on the demand curve. So this is not measured across the demand curve, it is measured at a point on the demand curve. How to find that? Already the formula has already been discussed. But however, when the price change is somewhat larger, or when the price elasticity is to be found between two prices or 2 points on the demand curve, in that case we better use arc elasticity. So this paragraph itself indicates a simple thing: when point elasticity is used, when arc elasticity is used. Point elasticity is used when the price change is smaller. Actual word used is infinitesimal. Again, we don't need to go into that. That much of technical knowledge is not required. Means smaller, let us say. Ideally, it should be called infinitesimal. But let us restrict it to smaller. So if the price change is smaller, then which method can be used? Point elasticity can be used. It is very small, very, very minute change. When the price change is larger, then we can use arc elasticity. Same way, if we want to measure the elasticity at a given point on the demand curve, we use point elasticity. If we want to measure the elasticity between two prices and 2 points, or let us call 2 different points on the demand curve, then we use arc elasticity. So that is the basic difference between them theoretically. So point elasticity is used to measure the elasticity at a given point of time, at a given point on the demand curve. Arc elasticity is used to find out the elasticity between 2 points on the demand curve. Similarly, point elasticity is used generally where the price changes are smaller. Once again, generally, or can't we use point elasticity if the price change is larger? Nobody said that. It can be used. It can be used also. It's after all a formula, a graph. You can do that. I mean, in real life, it can be done. So the point is not about can't we do. We can do anything. But we don't do that. We restrict ourselves to point elasticity to be calculated at a given point of time. That's it. That has to be used when the price changes are smaller. On the other hand, when the price changes are larger, we use arc elasticity. Also, when we want to find out the demand between 2 points on the demand curve, we use arc elasticity. There ends the matter. We can just stop it there. But that itself is a big discussion. There are definitely each point actually in economics can be further inquired into and research can be done on that. But once again, our limitation is only basics. We have to be just focusing on that. So the core aspects, yes, we should know. When point elasticity is used, when arc elasticity is used, we should know that. Remaining things related to the real life application, we don't really have to worry about them now. If we are really interested in the economics, and when we have understood the way businesses run at a later stage, definitely you can do that at a personal level. But as far as the foundation is concerned, in this Chartered Accountancy Foundation course, economics requires certain basic points to be thoroughly known rather than many points known just little bit. So that is the difference we need to understand here. Anyway, what about the other types of elasticity of demand? For example, income elasticity of demand. Same thing, logic is still the same. What is income elasticity of demand? It is a percentage change in the quantity demanded or demand of a commodity as a result of a percentage change in income of the consumer. So once again, Sir, we are using a quantity demanded here, not a demand. Use demand, sir, no problem. Nothing happens. Normally, we don't use the word quantity demanded when we talk about income. Why, sir? There is no reason. Just to differentiate. That's all. There is no big thing there about demand and quantity demanded. It's only about usage. It is only about the general norm, not any rule, not any law, not any particular theorem. Words do not have any of those big things. So simply, you can replace this with demand also, no problem. Income elasticity of demand is a percentage change in demand of a commodity as a result of percentage change in income of the consumer. So the relationship between demand and income of the consumer is tested by income elasticity of demand. And normally, according to the income elasticity of demand, we can classify the goods into categories like luxuries, normal, or inferior. Depending upon the responsiveness of the spending on a product relative to the percentage change in income. In other words, depending upon the income elasticity of demand of a product, we can call them as luxuries, normal, or inferior. Normally, what happens? Normally, when the income of the consumers increases, the demand for the products also increases. That's what normally what happens. However, in case of inferior goods, the reverse might happen. In other words, for inferior goods, when the income of the consumers increases, the demand for such inferior goods might decrease. That's an exception. Normally, income and demand are directly related. Exceptions always will be there. And one of the important exceptions is inferior goods. So this is the categorization of goods on the basis of income elasticity of demand, which we also discussed in the earlier sessions. Then what is cross elasticity of demand? Cross itself tells us we are talking about two different things. So cross elasticity of demand measures the percentage change in the quantity demanded or demand of a commodity as a result of the percentage change in the price of some related commodity. So what is changing here? Price of a related commodity is changing. And what is it having an impact on? It is having an impact on the quantity demanded of original commodity X. So here we can call original commodity X related commodity Y. And that related commodity also has two categories. It can be either a substitute or it can be even complement. So either way, there will be an impact of change in the prices of the related commodities on the demand of products. So how the original commodity will behave if there is a increase or decrease in the price of a substitute? In that case, what happens? The relationship is positive. In other words, if the price of the substitute increases, the demand for original commodity also increases. If the price of the substitute decreases, the demand for original commodity also decreases. That is a positive relationship, direct relationship. What about complements? That relationship is negative. What does it mean? Negative means, once again, if the price of the complement increases, then the demand for original commodity decreases. Same way, if the price of the complement decreases, the quantity demanded or demand for original commodity increases. That means the relationship is inverse relationship. If the products are complements, the cross elasticity is going to be negative. Even in computations also, this negative sign you have to keep, because it is indicating that the commodities we are testing are complementary to each other. Of course, we also know the other exceptions. For example, if the cross elasticity is positive, we can always say that they are substitutes. Maybe sometimes very perfect substitutes, sometimes lesser substitutes, but they are substitutes definitely, yes, when the cross elasticity is positive. But what if the cross elasticity is negative? Then can we say always they are complements? No. In general, yes. In general, they are complements. But not necessarily only because they are complements, the cross elasticity could be negative. It could be negative due to other reasons also, depending upon the income effect of the consumers. That also might have an impact on the cross elasticity. So, point to be noted once again. If the cross elasticity is positive, always the goods are substitutes. However, we cannot conclusively tell that if the cross elasticity is negative, always the goods are complements. We cannot tell that always. But are they generally not complements? Yes, they are complements. In general, yes. But there are certain exceptional situations also. So that is only a point to be noted in relation to the sign of cross elasticity of demand, which is also an important aspect. Then what is advertisement elasticity? We know that. Basically, that is the responsiveness of a goods demand to the changes in the firm's spending on advertisement. Means percentage change in demand divided by percentage change in the advertisement expenditure. That's what is given as advertisement elasticity of demand. Like this, there are many elasticities of demand, majorly being 4 categories, what we observed: price elasticity, income elasticity, cross elasticity, and advertisement elasticity. These are all measurable items. Of course, are these the only 4 factors that will be influencing the demand? No. There will be many other factors. But are we going to quantify them? Difficult. We are not going to do that. So, we are going to focus and restrict only to these 4 types of elasticities of demand. That's it. After that, we discussed about a concept of forecasting of demand, which is actually an art also and a science also of what? Of predicting the probable demand for a product or service for future. Of course, we have to take the past behavioral patterns on the basis of which only the future can be predicted, and also some of the events and trends prevailing in the current market conditions will be used to forecast the demand. Once again, we are not going to do the forecasting of demand. That is way beyond our level. We are only knowing that there is something called forecasting of demand. In that, experts will forecast the future demand using mathematical models, and using the past and present patterns, they will be in a position to scientifically predict what could be the possible demand in future. But still, end of the day, it is future. So, is it going to be 100% same what they told is going to happen? No, we are not talking about guessing here. We are not talking about dreaming or astrology. None of them is what is our concern. We are not talking about them. We are only talking about scientific forecasting. That's all. Scientifically forecasting is done. We should know that. How it is done? What scientific techniques are used for that? We need 2 years for that. Lot of discussion is there. Various degrees are there for that. So that is not our business. So let us not enter into that area. Just understand there is a concept of forecasting of demand. It is very important for organizations. Definitely yes. And different types of demand can be forecasted. Also, there are some techniques which are used for demand forecasting. Names only. What are those? Survey of the buyer's intentions. Taking a whole market survey or a sample survey, but ultimately taking some feedback from the existing customers or potential customers. That is one of the techniques. Or collective opinion method, which gives the opinion of huge number of sales force that is appointed by bigger organizations. Expert opinion method gives opinion of certain experts who have been appointed for the purpose of this demand forecasting. Like that, barometric method can also be used, and statistical methods can be used, like trend projection, graphical, method of least squares, regression analysis, all these things. And some other market studies like controlled experiments, controlled laboratory experiments, like this many methods can be used. All of them, we just need to know the names, and we don't have to really worry about what are those methods and how these methods are all actually used in the demand forecasting. It is much bigger than a PhD subject actually. So, not to be given too much focus on the details of them. We need to know the essence of them enough. What happens in collective opinion method? That's enough for us. How is it done? Are we going to do that? We cannot go out, no. We cannot go out and collect all this. That is not our scope. So, we just know that there are people who do that. That's enough. And there are people who know how to do that also. Experts are there, companies are there, especially huge consultants are there, international level, who will do all these things, who apply all these methods, statistical methods also, controlled experiments methods also, and all these methods put together can also be used, not one method. It is not that a company has to choose only one of the following methods, nothing like that. They can choose a combination of them also. Ultimately, what they want is a forecast of demand. If that is done using a proper scientific technique, generally it is better. No, if it is not done using these techniques, if it is done using dreams, using just guesswork, then it will give bad results. That's all. Who is going to suffer are the organizations. So organizations will decide whether they should appoint or apply any of these methods so that they can forecast the demand in a better way. That is their choice, their headache. Our point is only to note that there are many methods for demand forecasting. There are many techniques using which the demand forecasting can be done. Dot. That is about chapter 2, unit 1. Now, before going ahead with the other units of the same chapter, let us quickly go through some of the MCQs related to the theory of demand. Let us quickly go through them, and also let us go through the answers related to these MCQs. One by one. First question. Demand for a commodity refers to what? Read the options carefully. A says desire backed by ability to pay for the commodity. Looks fantastic. So should we put it? No. We should read the other options also. That is why I told you. You cannot be in too hurry to get the answers and try to get the marks in a quicker manner. That whatever swiftness, if it is helpful, it is good. If that converts to be little bit of hastiness, then it becomes a problem that will be counterproductive. It will just give us negative marks. So read the options. First one is not a wrong thing. Nobody says desire backed by ability to pay for commodity. Fantastic. Yes, it is also correct, but it may not be the correct answer. Being a correct statement is different, being the correct answer is different. So how to find out the correct answer? Reading all the answers, reading all the options carefully. So go to option B. Need for the commodity and willingness to pay for it. Fantastic. This is also looking good. Need also is required. Willingness is also required. Looks good. C point says the quantity demanded of that commodity at a certain price. That is also there. Basically, quantity demanded of a commodity at a certain price is what is demand, right? That also looks good. All are looking good. Demand is definitely having all these things. But what gives the perfect answer is this. So, what is the demand for a commodity? Basically, is the quantity of a commodity demanded at a certain price during any particular period of time. So, the demand cannot be just about these things. These are okay, but these are all inherent. Whenever we say demand, automatically there is a desire, automatically there is ability to pay, automatically there is willingness. All of them are already there. But all of them are there is only causing demand. But what is demand? Demand means the quantity of the commodity demanded at a certain price. At a certain price is not enough. C says up to here at least. But D is more comprehensive. So it says during any particular period of time. Yes. So demand cannot be a generic expression. It has to be an expression of quantity, definitely at a particular price, in a particular period of time, and of course at a particular place also, though it is not given. We know that. These things are all to be there, then only it is called as demand. So correct option, the better option, let us say, is D. So that will be the correct answer. That does not mean A is meaningless, B is meaningless, C is meaningless. All of them have their own good meaning, which is okay. But correct option, definitely the best one is D, Delhi, for first question. Second question. What is the contraction of demand? Contraction of demand is simply expansion, contraction, both are resultant of price changes. That we should know. So first one says number of customers decreased. It's ridiculous. It has nothing to do with contraction. So basically price is the only thing that we have to look at. A doesn't have the word price, B has word price, C also has a word price. But when we say the contraction of demand, that happens when there is an increase in the price of the good concerned. When the price of the commodity has increased, then only the quantity demanded is going to be decreased. Then only it is called as contraction of demand. So correct option is directly B. Here you don't need to spend too much time on reading C and D because it is a direct technical question. And if you want to just have a quick look at C and D, not a problem, but don't spend too much time on that. Here you have to spend time on all the options because all are looking good. But here, definitely all are not looking good. The number of consumers has nothing to do with contraction. Income doesn't have anything to do with contraction. Prices of other goods has nothing to do with contraction. All these three, A, C, D, all of them are factors other than price, which will have an impact on demand, yes. But that is called decrease in demand, but not contraction of demand. So A, C, D cannot be correct. When we use the word contraction of demand or expansion of demand, when the change in the quantity demanded is happening due to a change in price only. So here contraction means quantity demanded has reduced. Why it has reduced? What is the possibility? Only one possibility. Increase in price of the goods concerned. That's it. That is B option for question number 2. Then question number 3. All but one. These are very important type questions because you have to be carefully reading them and you have to understand the meaning of that. All but one. In other words, we have a odd man out in this 4. All except one. But one means except one. All except one of the following are assumed to remain the same while drawing an individual's demand curve for a commodity. So all of them are going to be same whenever we are drawing a demand curve. See, when the demand curve is drawn, first of all, demand curve means what? Demand curve is about the relationship between the price and quantity demanded. While we are testing this, all other factors are assumed to be remaining same. So what are the factors which are not going to be remaining same is question here. Of course, everything is going to be remaining the same except one. What is that? Straight answer. That is price of the commodity because we are talking about demand curve. Demand curve is about price of the commodity and quantity demanded only. So what changes in the demand curve? Price of the commodity changes. Quantity demanded also changes. What will not change? All other factors will not change. Like once again, preferences, incomes, prices of related goods, all other factors are assumed to remain constant. Price definitely is not going to be constant. When we are drawing a demand curve or a demand schedule, definitely the price is changing. It is not going to remain same. So it is the odd man out here in the 4. And it is what is asked. All except one of the following is assumed to remain the same. So all are going to remain same, but price of the commodity is not going to remain same. Because that is exactly what we are testing. That is exactly what we are identifying, the relationship between the price and quantity demanded. So how can the price be fixed? If the price is fixed, it is not going to change, then we cannot test the relationship. So that's why answer is C for third question. Then fourth question, once again, is a little bit, I would say, not correct to be asked, but what we can do, such questions are asked, whether we like it or not. But at least we have to use our common sense in answering such questions. So which of the following pairs of goods are examples of substitutes, he says. Examples of substitutes. Substitutes means one product can be used in the place of other product. Then only they are substitutes. Tea and sugar, are they substitutes? No. They can be used together, but not in the place of one another. Same way, pen and ink are also not substitutes. They are also complements to each other because they are also used together. Shirts and trousers cannot be used as substitutes. You cannot change the place where we wear them. So, shirt cannot be replaced with a trouser, trouser cannot be replaced with a shirt. Means not possible for them to be substitutes. So, naturally the only possibility is tea and coffee can be called as substitutes. Are they really perfect substitutes? Maybe not. but we don't care about it. As far as these four options are concerned, are they substitutes? Yes, they are substitutes. And are these also substitutes? No, definitely they are not substitutes. Nobody can have tea powder instead of sugar in making anything. Not possible. These two are not substitutes, and vice versa. Same way, pen and ink are not substitutes, shirt and trousers are not substitutes, that is for sure. Tea and coffee naturally are substitutes because they are remaining here, but does not mean they are perfect substitutes. We don't have to assume like that. And we don't have to remember always tea and coffee substitutes, not like that. We don't need to worry about them. If any such question comes, just need to apply common sense and identify the correct option. That's it. Next, question number 5. In case of a straight line demand curve, like linear demand curve, meeting the two axes, the price elasticity of demand at the midpoint. So point here is to be noted is midpoint of the line. How much is going to be the price elasticity at the midpoint is the question. Naturally, it is going to be 1. That is the unit elasticity, right? At the point where it touches the x-axis, it is going to be 0. At a point where it touches the y-axis, it is going to be infinity. And at the midpoint exactly, it is going to be 1. Below the midpoint, it is going to be less than 1. Above the midpoint, it is going to be more than 1. All these things we have already discussed earlier, particularly when we have a straight line demand curve. So, at the midpoint exactly, what is going to be the elasticity of demand? Definitely that is going to be equal to 1. Straight question. That concept of point elasticity, if we remember, automatically we can answer this question directly. No need of much further thinking process. So that is 5th question. Now 6th question. The law of demand, assuming other things to remain constant, establishes the relationship between what? Law of demand establishes the relationship between what? That is price of a good and quantity demanded. Is it not? That's what law of demand is all about, right? Law of demand is about relationship between the price of a commodity and quantity demanded of a commodity. So once again, a direct question. Income, no. Price of a good and demand for substitute, no. Law of demand does not talk about that. That does not mean, once again, income will not have an impact. Income will have impact, we know that. Substitute prices will have impact, we know that. Same way, complementary commodities prices will have an impact, we know that. But that is not law of demand. That is something else. As far as law of demand is concerned, definitely the relationship between two things is established. What are those two things? One is price of a commodity and the second one is quantity demanded of that commodity. So the answer for 6th question is B, Bombay. Next, question number 7. Identify the factor which generally keeps the price elasticity of demand for a good low. Identify that carefully. So what is he asking? Price elasticity to be low. So what could be that? A, variety of uses for that product. If there are variety of uses for that product, multiple uses as we discussed, what will be the price elasticity? Will it be low or high? In general, it will be high. Why? Because imagine, particularly when there is a price reduction, then people will be using the same commodity for new purposes also, which they might not be using it earlier. Because this product is possible to be used for multiple purposes. Earlier it was used for a few purposes. Now because there is a price reduction, the same product will be used by public for multiple uses, which naturally increases the demand, which means the price elasticity of demand is high in case a product has variety of uses. Reverse also is possible. We can take another example. Say for example, coconut oil. If the price of the coconut oil is high, maybe the use of that can be only restricted to cooking or restricted to only using it for hair care rather than using it for other purposes. So why a product is used depends upon its variety of uses for which it can be actually used. That means that variety of uses will motivate the people to buy more of that. If the price has become less, it will demotivate them to buy more of that if the price of the commodity becomes more. So naturally, such commodities where the same commodity can be used for multiple purposes will be high, not low. So definitely this is not a correct option. What about the very low price of a commodity? Yes, definitely this is a correct option. Why? Because when there is a low price of a commodity, like we discussed earlier, like example of salt or buttons or matchboxes, price elasticity of demand for that commodity will be very low because people don't care about the increase in price of them also or decrease in price of them also. Naturally, the price elasticity will be low. When the price of the commodity itself is very low, very small price it is, negligible price. So people don't really care about price. When price elasticity is low itself means people don't care about price. And when they do that, when the price of the commodity is already very low. That is correct option B. Actually, that is enough because it is straight question and we can identify that. But even for understanding purposes, if you read option C and D, you need to also know that these two are wrong options. C, for example, close substitutes for that commodity if they are there. Will the price elasticity be low? No, the price elasticity will be high. This also we discussed earlier with examples, say Pepsi and Coke. Very close substitutes. Because of which what happens? The price elasticity of them will be very high. But the question is asking about low. That means it is not a correct option. Option D, high proportion of the consumer's income spent on it. If it is really spending, if the consumers are spending more amount of money on that product, then the price elasticity will be high, not low once again. If the proportion of the consumer's income spent on a product is very small, small proportion only is spent, then only they don't care about the price of the product, right? If that is a very big chunk of their money, their disposable income, if it is being spent on one commodity, then definitely such commodity will have high price elasticity. Popularly, this is also called as discretionary spending, where the customers will have the discretion to either spend or postpone. And naturally, if at all there is a price increase in such commodities, the consumers will postpone. So high proportion of the consumer's income, if it is spent on that commodity, then it will have high price elasticity but not low price elasticity, which means once again it is not fitting the question. So the correct option for 7th question is only B, Bombay. Then the 8th question, identify the coefficient of price elasticity of demand when a percentage increase in the quantity of a goods demanded is smaller than a percentage fall in its price. So what is going to be the coefficient of price elasticity is asking. How much we don't know, but the tendency is given. Percentage increase in the quantity demanded is smaller, means the numerator is smaller than denominator. When the numerator is smaller than denominator, naturally how will be the price elasticity of demand? Naturally it is going to be smaller than 1. That's it, straight question. Numerator, that is percentage change in the quantity, increase or decrease, whatever it may be. And denominator is percentage change in price. If numerator is smaller than denominator, naturally the elasticity of demand is going to be smaller than 1. That is option C for question number 8. Question number 9. In case of an inferior good, the income elasticity of a demand is. Normally, how is the income elasticity of demand? Usually the income elasticity of demand will be positive. When income increases, people will buy more. Normally that's what happens. But we know that there is a variety. The variety is inferior goods. So in case of inferior goods, the income elasticity will not be positive. So what is the opposite of positive? Naturally it is going to be negative. In other words, when income increases, the demand for inferior goods decreases and vice versa. That's what is income elasticity being negative, which means it is an inferior good. That is question number 9. Then question number 10, if the demand for a good is inelastic he says, okay, that means there is no much of impact of price on the demand or quantity demanded of that commodity. It is relatively inelastic. Then an increase in its price will cause the total expenditure of the consumer. So If there is inelasticity, elasticity is not there. If it is inelastic, then increase in its price will cause the total expenditure of the consumer of the good to increase, remain the same, decrease, or any of these. So you have to remember which method here we are talking about: total expenditure method, total outlay method. That is what we can even call as a total revenue method from the supplier's point of view. But when the demand is inelastic, in that case, there is an increase in price. What happens to the total expenditure of the consumers, he is asking. Definitely will not remain the same, because if it remains the same, then the elasticity is equal to 1. That is unitary elastic. In other words, the total expenditure will not change. So that will not change only when a particular product is having a unitary elasticity, means equal to 1. Inelastic means less than 1. The demand is inelastic means price elasticity of demand is less than 1. Not more than 1, not equal to 1. It is less than 1. If it is less than 1, then what happens to the total expenditure of the consumers, he is asking. So increase in the price is not going to have a huge impact on the demand. It is going to have a little bit impact, but not a huge impact. But increase in price will cause the revenue or expenditure definitely to grow. So what happens here ultimately? That the total expenditure of the consumers will be increasing if a particular product is inelastic. In other words, elasticity of demand is less than 1. So if the elasticity of demand is less than 1, when there is an increase in the price, the total expenditure or total outlay or the total revenue of the sellers will also increase. That's what happens in case the commodity is inelastic. So there was a table that we discussed earlier related to this method, total expenditure method. That table, of course, we should understand that. Don't try to by heart that, but you should remember that also in case of changes that happen in the price and how that is going to have an impact on the quantity demanded, that we normally calculate as elasticity of demand. But when we use the expenditure method or total outlay method, then the calculations are little different. So what are those calculations we have discussed earlier? So we can directly go to that. Yeah, this is the table I was talking about, table number 5. This table you should be very much thorough with. So if the product is inelastic and price increases, total revenue also increases, price decreases, total revenue also decreases. And that is the question here. Demand is inelastic and price increases, so naturally the total expenditure also increases. Reverse is going to happen if it is elastic. So all these possibilities. Of course, unitary elastic, there is not going to be any change because the total revenue remains the same. Total revenue, total expenditure, total outlay, all are same. Total outlay and total expenditure from consumer point of view are expressing. Total revenue is from the seller's point of view, but ultimately both are same. We discussed that earlier. Now, if a product is inelastic, then the relationship between the price and the total revenue is direct relationship. If the product is elastic, then the relationship between the price and the total revenue is inverse. That has to be remembered in general, and that can be applied in all the possible cases. There are 5 different situations here. All 5, any of them can be asked as questions in the examination. This is one of them. Like this, many other situations can also be appearing in the questions. That is question number 10. Then question number 11. If regardless of change in its price, the quantity demanded of a good remains unchanged. So it means what? Price is changing, but irrespective of the change in those prices, irrespective of that, the quantity demanded of a good remains unchanged. There is no impact at all. Because of the change in price, the quantity demanded is not at all changed. It is completely unchanged. In other words, what can we say? In other words, the price elasticity of demand for that product is 0. When it is 0, how the demand curve is going to be? Already we discussed that also. That is going to be vertical. When if the price elasticity of demand is 0, because the quantity is going to be same. Quantity is not going to be changing. So if we look at a normal demand curve, if at all, a normal demand curve, when you have this like this, downward sloping demand curve, it is normal demand curve. What is happening here? As the price is decreasing, this is price on the y-axis, quantity demanded is increasing. This is what happens normally. But what we are talking about is here unchanged quantity demanded. Unchanged quantity demanded means quantity demanded is fixed. This is not going to change. So definitely how the demand curve is going to be, because quantity is fixed. Price is changing, but quantity demanded is not changing. Price is increasing here, let us say if you go, but quantity demanded is not increasing. It is going to be still the same. So that means the demand curve for such commodity is vertical. In other words, that is a place where the price elasticity is 0. All these things we discussed. You need to be thorough with them, not just generally listen to them and forget. You need to be reading them, remembering them, and you should be thorough with these concepts. When income elasticity is 0, the demand curve is vertical, or you can say parallel to y-axis. That's it. Under normal circumstances, demand curve is negatively sloped, but that is not what is asked. According to this question, in that situation, what is the answer? That we should put. That is B. That is vertical is the answer for question number 11. Then question number 12. Suppose the price of Pepsi increases. We will expect the demand curve of Coca-Cola. What happens to that? So this is a common sense question. Of course, first we should know Pepsi and Coca-Cola could be substitutes. That is first point. So when the price of Pepsi increases, naturally what happens? Demand for Pepsi decreases. When demand for Pepsi decreases, naturally what happens? The demand for Coke increases. So when it increases, we are talking it as increase in the demand, and then what happens naturally? There is a shift towards right. So increase in demand is a rightward shift. Decrease in demand is a leftward shift. So increase in demand is going to be a shift towards right. And why is that? Because they are substitutes. A also says they are substitutes, but it is giving a wrong answer, because it is telling that the shift is going to happen to left. So it is not going to happen to left. Left means decrease. But that is not what is going to happen here, because the price of the Pepsi is increasing. First we have to understand the impact on the demand of Pepsi. So if the price of the Pepsi increases, demand for Pepsi decreases. When the demand for Pepsi decreases, demand for Coke increases. That means the demand curve shifts rightwards. That is answer B, Bombay, for question number 12. Once again, question number 13 is a direct question. All of the following are determinants of demand except what? Except means, once again, odd man out type question. Tastes and preferences, will it have an impact on demand? Yes. So we cannot say except. Quantity supplied, yes. That is not there. Was it there in the determinants of demand? Did we discuss that? No. Quantity supplied will not have impact on demand. It will have impact on the price of the product, yes, that we will see later. But definitely it will not have impact on the demand directly. So there is no relationship directly between the quantity supplied and quantity demanded, because the demand or quantity demanded depends upon these factors. Taste and preferences, yes. Income, yes. Price of related goods, yes. These are all determinants of demand, we can say. Quantity supplied is not a determinant of demand. So that is why question number 13, option is B, Bombay once again. Next, question number 14. A movement along the demand curve for soft drinks is best described as along. What can we call that? So these are the questions I was talking about. So here along the curve means we are talking about the relationship between quantity demanded and price. So can we call it as increase in demand or decrease in demand, or generally can we call it as a change in demand? No, we can only call it as change in quantity demanded, not demand. A change in demand is different. A change in quantity demanded is different. When we use the word change in demand, when that is happening due to a change in any of the factors other than price. But here, if the movement is happening along the demand curve, that means the factor is price. and that price having an impact on the quantity demanded of the soft drinks. So that is why we use the word quantity demanded here. So C will be the correct option for question number 14. Then, if the price of the Pepsi decreases relative to the price of Coke and 7-Up, then the demand for Coke and 7-Up, what happens? So if the price of the Pepsi decreases, demand for Coke will decrease? Yes, of course it will. 7-Up will decrease? Yes, of course it will. Coke and 7-Up will increase? No. When the price of Pepsi decreasing, demand for Pepsi increasing first of all. When demand for Pepsi increasing, demand for Coke and 7-Up will decrease. So correct option would be D here, because both of them, considering they are substitutes, once again, how can Pepsi and 7-Up be substitutes? One is black color, one is green color bottle, like that we cannot say. So that is not our point here. Basically, we have to understand the essence of the question. The intention of the question is that these are substitutes. Definitely, Pepsi is on one side, Coke and 7-Up are on the other side. They are substitutes. When the price of Pepsi decreases, naturally, the demand for substitutes also will decrease. That's what we are talking. So, Coke and 7-Up demand also will decrease. Option is D, Delhi, for question number 15. Then question number 16, if a good is a luxury commodity, if income elasticity of demand, how the income elasticity of demand will be, if at all a particular commodity is a luxury commodity, is asking. Of course, if it is a luxury commodity, definitely the income elasticity is going to be positive, that is for sure. It cannot be negative. Negative when, if it is inferior commodity. Luxuries, commodities, income elasticity is going to be positive, no doubt. But how is it going to be? Positive but less than 1 or positive but greater than 1? Definitely it is going to be positive but greater than 1. Why? Because in case of luxury commodities, the income of the consumers is going to have a big impact on the demand of the products. It is not going to have a small impact. Less than 1 means impact is there but small impact. More than 1 means impact is there but big impact. So will the luxury goods demand be heavily determined by the income of the people? Yes. Definitely there is a huge relationship between income of the people and the demand, which means the income elasticity of demand for such commodities like luxury commodities is going to be stronger, which means the amount wise, number wise, it is going to be greater than 1. That is question number 16. Answer is C. Then some other questions are there for practical computation or observation purposes. The price of hot dogs is increases by 22%. Quantity of the hot dogs demanded falls by 25%. So this indicates the demand for hot dogs is what? Elastic, inelastic, unitary elastic, or perfectly elastic. First we should know what does it each of them mean. Inelastic means it should be 0. There should not be any impact on the quantity demanded of hot dogs because of a change in price. Perfectly elastic means it should be infinite. Unitary elastic means it should be equal to 1. Elastic means it could be more than 1. Now what happened? Percentage change in the quantity demanded is 25%. Percentage change in the price is 22%. So 25 divided by 22, is it going to be more than 1 or not? Definitely yes. Definitely more than 1. When it is more than 1, what can we call that? We can call that such product is elastic. Enough. It is not going to be unitary elastic, it is not going to be perfectly elastic. It is only elastic. That's it. Unitary elastic means the both should be equal. 22% increase means demand also should fall by 22% only. Then we could have called it unitary elastic, but it is not the case. Here the elasticity of demand is more than 1, which means the product is elastic. Answer is A for question number 17. Then question number 18. If the quantity demanded of mutton increases by 5%, when the price of the chicken increases by 20%, what is the cross price elasticity of demand between the mutton and chicken he is asking. See, forget about mutton, chicken and all that. You don't need to be worrying about the names once again. Hot dogs, all these things, not required. Mostly these would be examples copied from international books, naturally. So they kept it like that. Whatever it is. So the interest should not be on the commodity. It could be any commodity, X, Y, A, B, any names. Names do not matter much here. So two commodities are given here. So let us say C and M. So what happened here? The quantity demanded of M increased by 5% when the price of the chicken increased by 20%. So what is the cross price elasticity of demand between these two commodities, M and C, is asking. So what is the cross price elasticity? Two different things happened. Quantity demanded increased by 5% and price of the chicken increases by 20%. So quantity demanded increased by 5% means the numerator is 5% and denominator is 20%. Numerator is 5%, denominator is 20%. So 5% divided by 20% will be how much? 5 by 20. That will be 1 by 4. 1 by 4 is nothing but 0.25. That is clear. So answer could be either A or B. One possibility only. Absolute number 0.25, that is clear. 5 divided by 20. Numerator quantity demanded, denominator price. But observe that numerator and denominator are not related to the same commodity. Numerator is related to the mutton, denominator is related to the chicken, which means cross elasticity is what we are calculating. So in this case, what is the nature of these two commodities? We have to identify from the question, not according to our assumption. We cannot assume that mutton, chicken are in anywhere substitutes. No. From the question, whatever the data is there, from there we have to derive what is the nature of these two commodities. This question says the quantity demanded of M increases by 5% when there is a price increase in C by 20%. So when there is an increase in the price of substitute, then only increase in the demand for related commodity will be increasing. In other words, both are positive, right? Simple. Directly you can understand that. What is the essence here? Both are increasing or one is increasing, one is decreasing? Both are increasing. So what is the sign here? Positive. Positive 20%, positive 5%. So when a particular commodity is positive or the cross price elasticity is positive, what can we call those two commodities as? Substitutes. So naturally when it is positive 0.25, answer would be B. Rather than minus 0.25, it would be 0.25. Because these two are substitutes. That can be understood quickly if we just apply both positive numbers in the formula. That was question number 18. Answer is B, Bombay. Then question number 19. Given the four following possibilities, which one results in an increase in the total consumer expenditure? Once again, expenditure method, outlay method, or total revenue method. Very important method, that is, though we cannot calculate, we should be able to identify the tendencies. What is the requirement here? One of the following things, one of the following four possibilities, there is one only which will result in an increase in the total consumer expenditure. What could be that? First one, if the demand is unitary, basically it does not increase the consumer expenditure because demand is unitary itself means what? That is going to be no change in consumer expenditure. So we cannot call A is a correct option. B, demand is elastic and price rises. See, when the demand is elastic and price is increasing, see, for any elastic product, the relationship between the price and consumer expenditure is going to be inverse. So when the price rises, consumer total expenditure decreases. So increase is not going to happen here. So B is also not a correct option. Option C, demand is inelastic and price falls. Once again, when the demand is inelastic, definitely the price of the commodity and the total consumer expenditure are positively related, directly related. So if price falls, the total expenditure also should fall. But here he is talking about increase. So this also cannot happen. C is also not possible. Of course, obviously, the remaining D is the only option, which is the correct option. But we should know why is it correct option also. In the examination we may not be, but at least learning process wise, we should know why D is a correct option. Look at the situation. Demand is inelastic. Okay. Immediately our brain should tell us demand inelastic means the consumer expenditure and price are inversely related or directly related. They are directly related. When the demand is elastic, the price and consumer expenditure are inversely related. Those are having an inverse relationship. Here, this is increasing, this is decreasing, this is decreasing, this is increasing. So when the goods are elastic, when the goods are inelastic, then price and total revenue are directly related. This is increasing, this is also increasing. If this is decreasing, this is also decreasing. So here, what are we talking about? Total consumer expenditure is increasing. Is it going to happen now? Demand is inelastic and price rises. Yes, that is going to happen, because when the price rises, definitely the consumer expenditure also rises. This is what we are talking, this option. Price rising, total revenue also increasing. Total revenue means total consumer expenditure also increasing. Like this, some of the questions in demand theory can be approached and answered. We'll continue with some more questions in the next session, but before that, everybody should be thorough with many of these concepts, and you have to be reading the textbook also thoroughly. This is just I would say, a glimpse of how the questions can be asked in the examination. So keeping them in mind, revise the chapter very well, read it very well, all the concepts of demand, computation of elasticity of demand, and not only that, even the budget method or total outlay method is also asked many times. And how to calculate the elasticity of demand anyway is going to be one of the important aspects. So all the things that we discussed in the earlier classes, you need to be thorough with them, and accordingly, more thorough we are, better we will be in a position to answer the questions comfortably, and naturally that will result in more marks, right? We'll continue this discussion on the questions in the next session. Till the time, take care. Bye bye. Thank you very much.